Welcome to The Explainer. Today we're digging into September 3rd, a day when the U.S. stock market was, well, a bit of a puzzle. You had tech stocks shooting for the moon while the rest of the market just kinda sat there. So, what gives? We're going to break down the two major forces that were playing tug-of-war with the market and what it all signals for the future.
Yeah, take a look at the scoreboard. It was a really mixed bag. The Nasdaq, which is full of tech companies, just rocketed up by a full percent. It even dragged the S&P 500 up with it. But then you look over at the Dow Jones, and it actually lost ground. Now, this isn't just random static. This split tells a really specific story about what's on investors' minds right now.
All right, so here's how we're going to connect the dots today. We'll start with this mixed picture, then dive into the two big reasons why it happened, a huge court win for Google, and some surprising new data about the economy, and then we'll figure out what this all means for you. Ready? Let's jump in.
Okay, first up, a mixed day on Wall Street. The headline here is that tech was the star of the show, but there was a lot of caution in the air everywhere else.
And these final numbers really tell the tale, don't they? You see the Nasdaq up a whole percent. That's huge. But the Dow, which represents more of the old-school industrial side of the economy, actually ended the day down. It's a perfect picture of a market with two completely different moods.
So, why the split personality? It wasn't an accident. This all boiled down to two massive news stories that hit on the same day, pulling the market in totally different directions. All right, let's talk about the first one, which was hands down the biggest story of the day. It's all about Google and a massive court ruling.
So for a while now, Google's parent company, Alphabet, has been under this giant legal cloud. They were facing a huge antitrust lawsuit. The fear was that the government could actually force Google to break up its business, specifically to split its Chrome browser away from its search engine. That would have been a fundamental change to how they operate.
And this brings us to a really important term, especially if you're learning about business English: antitrust ruling. Basically, these are laws and court decisions designed to keep the playing field fair. They're there to stop one company from getting so powerful that it creates a monopoly and crushes all the competition. It's a really big deal in the business world.
But the court came back with a huge win for Google. Just a massive victory. Not only do they get to keep Chrome as part of their main business, but a super important AI deal they have with Apple is also safe. For Google, a giant dark cloud just poof, disappeared.
And how did the market react? Oh, just like this. A 9% jump in Alphabet stock. That is a huge move for a company that big. It was like a collective sigh of relief from investors, and that one stock's surge was powerful enough to lift the entire tech sector.
Okay, so that's story number one. But the Google news was only half of the equation. While tech was popping champagne, the rest of the market was glued to a completely different story, one about the health of the entire U.S. economy.
So some new data came out, and it showed that the number of job openings in the U.S. just took its biggest nosedive since the pandemic. This is a massive signal. It tells us that the super hot job market we've been hearing about for so long, it's finally starting to cool off.
Now, this is where things get a little weird, and it's a key rule for investing. Sometimes bad news for the economy is actually good news for the stock market. Why on earth would that be? Well, if the economy is slowing down, it means the Federal Reserve, the U.S. central bank, is less likely to keep interest rates high. In fact, it makes them more likely to cut rates in the future to give the economy a little boost. And this wasn't just investors hoping and dreaming. This idea got a little extra juice from comments made by a top Fed official, Christopher Waller. He basically hinted that a rate cut might be on the table. That's like music to investors' ears. And you could see this happening in real time in the bond market. The yields on government bonds, which are super sensitive to what people think interest rates are going to do, fell pretty sharply. That's the market's way of placing a bet. And the bet is that rate cuts are coming.
Okay, so let's recap. We've got two big things happening. Tech is celebrating, and everyone else is hoping for lower interest rates. So if you're an investor, how do you play this? Let's break down the investor's playbook.
All right, the optimistic side, what we call the bull case, is pretty straightforward. You've got less legal pressure on big tech and the potential for the Fed to start cutting rates. Throw in the ongoing excitement about AI and some big company deals still happening, and you've got a recipe for more growth. But there's always the other side of the coin, the bear case, or the reasons to be nervous. For one, September is historically a pretty crummy month for stocks. And the big worry is this: what if the economy doesn't just cool down nicely? What if it slams on the brakes and skids into a full-on recession? That's the fear. And this crummy month thing isn't just a feeling. It has a name, the September effect. It's a fascinating market theory. It's what's known as a market anomaly. Basically, a pattern that shows up in the data year after year, but no one's 100% sure why. For whatever reason, September just tends to be the weakest month for stocks, and that history makes a lot of people cautious.
So you've got this tension, right? The bulls versus the bears. So let's look ahead. What are the key things we need to watch that could tell us which side is going to win out?
Keep your eyes on 3 things this week. First, an earnings report from Salesforce, a huge software company. Second, we'll get some new data on manufacturing. And then, the main event, Friday's official jobs report. That's the one everyone's waiting for. It's going to give us the clearest picture yet of where the economy is really heading.
You know, what's really interesting is that if you look at the market's fear gauge, it's an index called the VIX. It actually went down today. That suggests that, on the surface, investors aren't really panicking. They're feeling pretty calm about the next few weeks.
But that calm is a little misleading. If you dig a layer deeper into the options market, you see something else. Traders are betting on some big price swings for those AI stocks. This is a concept called implied volatility, or IV. Think of it as the market's prediction of future turbulence. High IV means people are expecting a big move, up or down. So while the main fear gauge looks sleepy, under the surface, there's a lot of nervous energy building up.
And that really leaves us with the big multi-billion-dollar question. Right now, the market is betting on a soft landing, that perfect scenario where the economy slows down just enough to beat inflation but doesn't crash into a recession. But right now, that's just a hope. It's a bet. And this Friday's jobs report is the first major test of that theory. Will it prove the optimists right, or will it be a serious reality check? We're about to find out.